Hi, I'm John Mark Young, financial advisor with Whitaker-Myers Wealth Managers. And today I want to talk to you about a very simple strategy that we use with some of our clients to help them reduce the cost of private school tuition while their children are still pre-college. It's using the 529 plan, which will be beneficial for clients in some states and not beneficial for clients in other states. For example, our clients in the state of Texas or the state of Florida, Arizona, Tennessee, where there's no state income tax, these strategies probably don't add much value, but certainly to those clients in Ohio, West Virginia, Pennsylvania, South Carolina, Georgia, they may be a little more beneficial. Now, let's say you send your child to a private school. Uh, Private school pre-college, so anything K through 12, you obviously have some sort of tuition cost to do that. If you're just outright paying the tuition, most schools use a system called FACTS to actually bill you and deduct that out of your bank account each month. One thing you can and maybe should be doing is putting money into a 529 up to your state limit of tax benefits and then immediately withdrawing it or whatever the plan allows. For example, the Ohio College Advantage plan typically requires you to keep the money in there a week or so in the money market account, so it's not going to earn much interest, but it's also not going to lose anything, and then take it immediately out to pay those tuition benefits. Now, why would you do this? Well, you would do this because each state has some sort of tax benefit that they would give you for putting money in that you can claim even though you took it right back out to pay the tuition payment. For example, somebody that's in the state of Ohio, let's use an example. Somebody's in the state of Ohio, they make $95,000. Okay, now we're assuming that this couple's married. They're going to pay roughly about a 3.8% state income tax to the state of Ohio. They're allowed to take a $4,000 tax benefit, tax deduction for anything put into a 529 for each child. So let's assume they have two children. So they make $95,000 a year. They're paying, somewhere in the probably range of $15,000 to $20,000 in tuition for these children. They put $4,000 each into a 529. They're going to save $304 from that Ohio tax benefit there, the deduction that they're able to take in that example. Now, some states offer tax credits and some states offer tax deductions. Like Ohio does a deduction. West Virginia, right next to Ohio, does a tax credit for putting money into a 529. There are nuances to that, and certainly talk to your tax advisor or your financial advisor for more specific information to your situation. But imagine that couple, they just reduced their tuition bill by $300 a year by just simply contributing and then taking right back out. Not very hard. A few clicks of the button, so to speak, to make this happen for a modest amount of savings on their tuition bill. Now, this obviously assumes you're not saving in a 529 today for your child's college. You say, well, we already are. Well, then this is not going to be a benefit for you. But let's say you're saving in a UTMA, which is a savings for your child that you can invest that's not specifically for college, or you might be using an ESA to fund your child's college. Then this scenario is to your benefit. Again, assuming that you have tuition payments to a private school that you're paying. So just a real quick tip that we like to give clients, we thought we'd put it into video format. So if you have any questions about this in your particular situation, please reach out to your financial advisor. In the notes or section of this video, we have put a very quick a link that you can click to schedule a meeting with any of our advisors if you'd like to talk about this, either through a video chat or in person. Thanks so much. We'll look forward to talking to you soon.